Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hey, audience and listeners, this is James Kandasamy from Achieve Wealth Through Value-Add Real Estate Investing podcast. Today, I have Kent Ritter, who has been focusing on the market of, Midwest, right? So, and he's been focusing a lot on, small apartments, leveraging technology. So we're going to go a bit more detail into each one of that and how is it making it successful. Hey, Ken, welcome to the show.
Thanks, James. Appreciate you having me on.
Sure. Why not you tell our audience about what do you do, what are the assets you own, and how do you work with others, and how are you indulging yourself in the multifamily investing space?
Yeah, for sure. Happy to go into all that, and just to give a little bit of background on kind of where I came from in multifamily. I really started out as a passive investor. Started out by investing passively in a lot of deals, about 10 deals at first. Used that to really learn the ropes, but also to really fall in love with it and realize that this was something that I wanted to pursue real as a career and make my full-time job. And, so I started passively and then decided, I caught the bug and decided to become an operator myself. So I'm currently, we syndicate deals. Currently, I've syndicated about 340 units. And as of last year, just middle of last year, I joined up as a partner with a larger firm called Birge Held Asset Management, which is owned by a mentor of mine, a man named Birge. And it's really given me the opportunity to build off of their platform. They've got a vertically integrated platform, a very sophisticated operating model with $1.5 billion in assets under management. But I'm able to use that to build my own business and focus on my own deals. And within that, we've had about 190 units that we've acquired in 3 deals in the past 6 months. And like you said, they're all in the Midwest, Louisville, Kentucky, Lexington, Kentucky, and Dayton, Ohio. And because I'm based in Indianapolis, so it's kind of about couple hours to each of those. And we're really focusing on smaller properties and more tertiary markets. I mean, thinking that if you look at even markets like Indianapolis and how prices have risen and how high the competition is, it's really tough to make deals pencil. I think if you're conservatively underwriting and underwriting in the right way. So we started looking at other markets and at smaller deal sizes where the competition is just different. The buyer profile is different, right? It's not institution trading to institution and a ton of competition. There's much less competition because honestly, it's harder to do smaller units and nobody coaches to go do small units, right? Everybody that's in a mentor program is being told, go big, do 100, 150 plus. So I saw that as a gap where I can play. And then the seller profile is different too, right? We're not buying largely from sophisticated owners. We're buying from mom and pops, from folks that have owned it for 20 or 30 years and have managed it, but have left meat on the bone, So we're seeing opportunities where we're seeing higher return profiles than you would see from larger deals in the same market because we're buying at value, we're fixing management problems, and we're bringing the capital to the deals to really get the most out of them.
Yeah, that's very interesting, right? I mean, you are right. A lot of people teach us go and buy 100 unit plus, right? Because of management ease, and they think that you can just syndicate and still do your W-2 job, and you can you can run these properties, right? So
right.
I do teach, you can start from small because I started from 45 units. and now
Gotcha.
almost 2,000 units. So, but I know that smaller number of units, you can buy from mom and pop, less sophisticated sellers. At the same time, the buyer pool is different, right? You're probably competing with single family, maybe 10 units people, and so you'll be the big fish in the tank when you go into
Yeah,
the 30 to 70 units deal, right? So which makes it
that's right.
a different
That's right.
advantage, right?
And we've been able to use that to our advantage.
Absolutely.
There's, I mean, a deal that we recently won. I mean, I can tell you that it was our reputation that won the day. It was, a market that we, market that we knew, broker that we didn't have a really close relationship with, but just the reputation, we were able to win the day, even if our terms weren't, wasn't the highest price. Well, it wasn't exactly the best terms. So there definitely is a competitive advantage there.
Yeah, absolutely. So is it because you chose the Midwest? Is it because you live there and that's your backyard? Is that why you chose the market, or was there any other reason in terms of any other
Yeah.
demographic reason?
I mean, that played a big role in it. I mean, one, just being there. I mean, I think it's more difficult. I just don't know how you can, if you're really operating it yourself, and you're in charge of asset management, and you're, especially these smaller properties, or even more in charge from a property management standpoint, how you could do that without being able to be physically present at the properties. I mean, it'd be really hard to do remotely, to do it at a level that you really need to be doing to execute it at the level that we want to execute, at least. So physical location definitely is important. And then also, just, I like the Midwest because the Midwest it's not cyclical. It's kind of steady Eddie. You're not going to hit the headlines, even though Indianapolis and Louisville and others have been hitting the headlines recently. You're not going to see that 8-10% a year rent growth, right? But we are realistically seeing 5% a year rent growth. And it's something that you don't see those big ups and downs, right? It just kind of steadily works its way up. We also have seen a huge logistics boom here, just being so centrally located. You've got, FedEx headquarters is in the Midwest, UPS, from like or at least their North America logistics headquarters. And then with all the, especially with COVID and with Amazon booming, I mean, we're just seeing a lot of benefits from just where we're geographically located. And lastly is just value. Midwest historically, and it's still true, has had cap rates that are anywhere from 50 to 100 basis points higher, to even up to 200 basis points higher than other markets that are hotter and more competitive. So we're able to buy at a value, and because we can do that, we can return cash flow immediately. And it's not a situation where we have to overraise to give the cash back. I mean, it's true operational cash flow out of the deals. So, we like to be in that position to be able to give a 7 or 8% cash on cash return that first year.
Yeah. Interesting. You talked about overraise to provide cash flow. Do you see operators doing that?
Yes. if you're in a market, if you're in a 4 cap market, or even a low 5 cap market, and the sponsor's promising that you're going to be getting your full pref, if it's a 7-8 pref that first year, then they're probably raising the money to give it back to you. It's just, I mean, it's just what I've experienced, that like the math just doesn't work.
I know. Well, I brought it up because it's a big topic that I brought it up in LinkedIn, and one of my posts, which got like almost 15,000 hits on LinkedIn, because I was wondering, how do people pay 8% pref on a value add on when they were already overpaying for deal, and I figured out, actually, they're probably overraising the deal. And that's what someone told me. Hey, you just overraise and do it. I said, well, why are you doing it, right? I mean, you're just trying to please the investors.
Yeah. I mean, it's just not, it dilutes the overall returns. I mean, I think it's
what was the word you used?
What's that?
You said dilutes.
Oh, I said it dilutes the overall returns, because you're, but anyway, that's there's a lot of things you see out there if you really understand the numbers behind it, and you say, well, the math just doesn't work. That's impossible. So there's got to be something else going on.
Yeah, I know. It's crazy people are doing that, because that's basically, you preach a lot about, getting cash flow from real estate, and now you are not really getting cash flow from real estate. You just create a separate escrow fund to pay
Yeah.
back people. And I mean, investors
Yeah.
are happy they're getting day one money, but are they really getting it from the deal? And everything will
Well,
be
you're given a loan, right?
you're given a loan. You just
You're
give back
gi-
your own money. That's a
yeah.
joke, right? So I mean, everything will be fine if the market keep on going up, but when market flattens or going down, that's where you
Yeah.
have to declare, hey, actually, we are not making money from the real estate. We are just have this separate account. But that's a
Right.
separate
And
discussion, I guess.
yeah, and just for the investor's sake, I mean, all of that should be declared in there. If you're reading the PPMs and you're going through those
Well,
documents,
everybody claim they declare, but I've read the PPMs. I can never
yeah.
see any word there. I mean, nobody's going to say when I raise the money, actually, for the first year, I'm going to over raise and pay you back.
Right. Right. Well,
Nobody
yeah.
mentioned it in webinar, right? So,
So that's a different story in and of itself too. That's a whole nother thing.
yeah.
But
Well, I mean, I just want to bring it up because you brought up a good point. And for me,
yeah.
we all do a lot of value add. And I always tell my investors you have to wait 6 to 9 months or sometimes 12 months for us to stabilize the deal. That's where we start paying out because ours is all true cash flow from the
Yeah.
real estate, right? And everybody's okay with that. Everybody understands we are doing a value add, we're doing turnaround.
Right.
But compared to another deal where and people come and say I need monthly cash flow from day one because the other guy is paying for it, and
Yeah.
it's very hard
Well,
for us to explain.
you're hitting on two things that I think are super important. One is just setting investor expectations, right? And I find that in life, like I spent 12 years as a management consultant flying all over the country. And I spent a lot of time in airports, and I've used this example before, but it's like everything starts and ends with communication, and you see that nowhere else greater than when a flight's delayed, right? And there's either two things that happen. One, people just totally go insane, right? And get mad and they're yelling and they're angry, or the other one is people kind of say, well, okay, and they accept it and they go and get another beer or do what they're going to do, and we all kind of move on. And the thing that I started noticing, because I guess because I was a consultant, I think about these things is why, and it all comes down to really communication and how they're communicating, on the delays and why things are happening and giving context. And most people are reasonable if you do that. Same thing with it's a long story to say, same thing with the deal. If you're just setting expectations up front and explaining in context why, I think people understand that. And if they don't, then that's the other point, is that investor then isn't aligned for your type of deal, because some people want cash flow. Some people want just wealth generation, right? And they're willing to not take the cash for that. People want different things. So it's extremely important that you have that conversation with the investor up front and pair the investor to the right style of deal.
Well, I mean, the fact is it's very hard to find an 8% cash flowing deal on day one. Otherwise, the institutional guys will come and grab it in a heartbeat, right? So because
that's why you got to do 50 units. They don't want that stuff.
Oh yeah, absolutely. I mean, what you are doing, smaller multifamily is actually a really, really, really good strategy, right? I mean, the thing is you have to work harder, which is if you're okay when you are, when you are making money and you are starting up and you're okay to do that, right? I mean, sometimes people just want to go big because they want to go big quickly.
Yeah.
But for
so
me,
here's the X factor of all this. We underwrite all the deals independently. They all stand on their own. But the broader strategy is, what if I acquire 1,000 units in total of all these smaller properties, and we put our management team on it, so it's got turnkey management, and you turn around and you sell that to an operator or to an investor, a larger institution that wouldn't be interested in 50, but would be interested in 1,000. And now you're able to achieve a portfolio premium because you're opening it up to a buyer pool that wasn't interested and all of a sudden is. And even the ability to offer turnkey management on that. I think there's a real X factor to what we're doing that we're not underwriting to, but could and I think will be a game changer if we're able to execute that strategy.
Yeah. I mean, I had another guest a few weeks back which did the same thing. He took one of the hottest market in Texas, and he looked for all the small deals, and he started buying in that neighborhood, right? So that he's trying to see. He said the same thing. I can group all this and sell it as a package, right, to a big guy, right? So, but he was looking more into luxury community, right? He's trying to get this older, smaller property and making it into luxury, putting technology, doing a lot of renovation on a new roof, new AC, so that you can bring down the cost. How's your strategy? I mean, are you guys just buying it and just doing a small value add? Or are you guys doing big value add? Are you putting any technology in it, or how is that?
Yeah. No, that's a great question. And, our strategy right now, and some of it has been, a lot of it has been informed from, one, the track record of Birge Held and the history there, and the 65 deals that have been acquired, and the lessons learned on those. And then part of it has been informed by just the environment that we're in right now with COVID and everything that's going on. So our strategy is really on this portfolio is lighter value adds. So really focusing on things that are going to drive revenue growth and really add value. Making sure that we're not overspending, right, is the big thing. Like making sure we're not overspending, making sure that we're keeping our basis relatively low, which reduces risk, right? It means that we don't have to, if we only spend 4,000 or 5,000 a unit, we don't have to achieve 150 or even $100 rent bump to make our numbers work. I mean, we have a deal that we're executing on right now, the one that's in Dayton, Ohio, where we've underwritten it, and it's a 3-year hold. We have IRRs that are projected, north of 20 on that. And we're looking for a $60 rent bump because we just did it in a smart way. So you don't have to go in, and if you do it in the right way, you don't have to go in and say, I got to raise rent $200. Otherwise this deal's not going to work. So one, it's a lighter value add. Two, it's focusing a lot of time on what I call revenue generating amenities, things like fiber optic internet. So we're installing fiber optic internet across an entire portfolio, and we're becoming the internet service provider for the residents. So I love that because you're not adding an additional financial burden to the resident. We're actually lowering typically their internet fees by about $10 to $15 a month, but we're giving them a better service. We're giving them fiber direct to their door, which is like 200 megabits up, 200 megabits down, which really matters when you're at home doing Zoom calls and kids are doing remote schooling and all that, right? So we're able to shift that revenue to us and to the property versus to someone else. We're also doing that with things like washers and dryer rentals. So we love finding properties that have washer and dryer hookups and setting up a washer dryer rental program. Again, they're paying somebody to do their laundry. We would just like them to pay us. And in exchange, we give them brand new units. So we focus heavily on things like that. So less on the actual value add, more on the amenities that are going to drive value, not physical amenities, but other things. And third is technology. So, the hardest thing about a small property is how do you manage it? Because you can't afford full on-site staff, right? So the way that we get around that is by creating like a scattered site portfolio where you have one manager who's managing up to 200 units that are, concentrated, but not in the same property, right? Like we have a manager who manages between Louisville and Lexington. And he's able to do that because we have smart locks on the property. We have software that sits over the smart locks that allows for remote access. So he can control access to the buildings and control access to individual units. So it's not only a benefit for the resident who can now, use their phone to enter their unit because it uses Bluetooth technology, but also the manager can manage remotely and not have to be directly on site. And then what we've also been able to do with the smart locks is implement a self-guided tour technology. So we're working on creating this contactless leasing process where someone can go online, interact with our chat bot online to feel like they're talking with a real person. They can sign up and they can say, I'd like to see a unit. And they say, well, would you like to see a virtual tour or would you like to do a self-guided tour? And they're able to select, they can do a self-guided tour. And what happens is there's geolocation beacons in the property. So using the person's phone, we actually know where they are on the property and we can curate the tour to them based on where they're at. So for example, somebody goes, they click, they want to do a self-guided tour. They set up their appointment. They come up to the property, they receive a one-time code on their phone to enter the property and enter the unit. From there, we track them through the property, and it's really cool because it's like it's a curated experience. So the experience is like if your best leasing agent was giving their best tour all the time, and it's actually professionally voice recorded. So they walk up to the pool. We know they're at the pool, and it says, "Oh, welcome to the pool." And someone reads them off all the information about the pool. They go to the fitness center, same thing. The unit, same thing. Tells them about the property as they're walking through it. It's a really cool experience, and they can have all that. And then at the end, it's all tied up with a virtual lease. So they can sign up for a lease right there, and leverage DocuSign and do that. And at no point in time did they ever have to physically come in contact with anyone. So it's benefit to the residents, or potential residents. They can schedule tours outside of times when the clubhouse is open, or if there's not even a manager on site, right? And it allows people to have that security of not having to be face to face, during COVID. So it's been a win-win. It's really cool. And we're just continuing the no-touch lease was the first proof of concept or use case. And then other things, we're continuing to just build out management efficiencies with different technology that we roll on. And the next big thing we're going to be rolling out is a centralized call center.
Wow, that's awesome. I mean, that's really good technology implementation, right? You probably don't have to have a leasing agent in that case, right? So
no, you don't really. The manager can handle it. And it reduces the number of leases, or reduces the number of tours. It actually increases the number of tours, but decreases the number of tours that you have to physically be there to
correct.
do.
The touches that you need to have a person to do it, right? So.
Exactly. And the next level will be, once the call center is up and running, which will be later this year, is the ability to centralize that contact, so they can actually be talking with a person. I mean, we could be chatting like this. You could be in an apartment right now looking around, and I'm in a call center and I'm talking with you about the apartment and about the neighborhood, and about the experience. And so that's kind of the next level that we're seeking to gain.
That's good. That's very good. Very good. So which vendor does provide this geolocation and connection to the leasing to a virtual tour?
Yeah. So the self-guided tour vendor that we chose, and we went through, so I lead a technology committee within our group, and we went through a very extensive process to vet all these different technologies, because there's so many out there. The self-guided tour that we chose is called Tour 24, is the name of the company. And I like them because that's all they do is self-guided tours. A lot of the companies that we looked at, they wanted to bundle. Maybe they'll give you the locks, they'll do the access control, and they'll do the tour or something. Well, we already had those pieces in place. So we really went for a best of breed model, finding the best locks, the best access control, the best tours. And Tour 24 is the one that allows us to do that.
Awesome. So basically, when someone want to come and visit the unit, they basically, call in or log in or through a messenger or chat bot, I guess, right? So
you can do it on the website.
Okay, and then when they come, they don't have to even go to the office.
Nope.
Right. So
like our 30 unit in Louisville, we don't even have an office.
Yeah, well, that's good. So you get which unit are available on your phone, and they're going to choose where it's located, and then they get a code to enter into.
Exactly right. And you just hold your phone up to the lock, and the lock opens.
Oh, really? That's awesome. So when you go in, and there's somewhere where there's recording to talk about the unit. Is that right? Someone would have recorded it.
It's all in the app. So before they come to the tour, they download the Tour 24 app, and it's all run through the app. And the other great thing is, from a liability management perspective, is before they're allowed to schedule the tour, or as they schedule the tour, they have to, the prospect takes a selfie on their phone. They have to take a picture of their ID, and they have to put a credit card on file.
Okay, got it. So to make them some liability, right? So
exactly, it's liability management. We want to make sure that the people that are coming on site are who they really say they are, and we want to make sure that we have their credit card on file in case they were to do anything destructive.
That's awesome. And what about the internet provider that you guys have chosen? I mean, you said you use fiber. Did you guys use another vendor to lay out the fiber, or did you lay out your own fiber and you put your own software on top of it?
So we do it ourselves. So we actually pay the capital. So we capitalize that within each deal to actually run, bore the hole, run the fiber into the ground, and then we partnered with a service provider to actually give us the software, actual yeah, the fiber, let the data flow, however you want to say that. So
But
they're
don't you
actually
have to
providing
connect
that.
to each units on the network connections?
Yeah, so they come in and they wire the
Okay.
property. Yeah, they
So
come in
there's
and wire the property, and then we actually hardwire Cisco routers and modems in each of the units. So the benefit for the resident is they don't have to deal with the cable company anymore. Like everybody hates the cable company,
yeah,
right?
everybody hates the cable company. Yeah.
And I've moved apartments so many times. Like I hate that, like you got to wait 2 weeks to get internet or something. You know what I mean? So what the cool thing is, we can, because it's already wired, the person moves in, all we have to do is literally go into an app, click a button, and their internet's live and they're ready to go. And so it's really easy for the resident. It's one less bill and customer service and everything else to have to deal with. And it's been a we've had resounding praise for the fiber of everything we've done. People have loved that.
Got it. Well, I'm a technologist. I used to be a network engineer, so I want to understand this a bit better. So you lease the fiber cable from the city or some company, and so they basically, you pay them, you capex the fiber installation, right? And that comes to the office. But the thing is, the same contractor would have wired the entire apartment community with Cisco routers, is what you're saying, I guess, right?
Yeah, they do it all. Yeah, they do it
Okay.
all, from, we pay somebody to dig the hole, and then they come and they lay the line, they wire the building. And we front the capital. I mean, we do a.
And how much would it cost, like for 50 units? I mean, whether the number of
So
units doesn't really matter, I guess. So fiber is fiber, right?
Well, yeah, it comes out to about 1,500 a unit.
Okay.
Yeah, it comes out to about 1,500 a unit.
The whole
to
thing,
do
I
it.
guess, the software plus the hardware, I guess, right? So
The initial capital cost, yeah, is
okay.
about 1,500 a unit, and then from there, there's a service fee,
per month,
but
right?
the monthly service fee, but it's that's just part of what we're passing through to the resident for their internet charge.
But you get the full internet fee from the resident, right? That's an annual.
We do. So we get to keep the difference, right? Okay. And the way that we do it is we do a market survey of internet service providers, and we try to undercut the market by anywhere from $10 to $15. We want to make it a no-brainer for the residents to say, like, why wouldn't they do this? It's better product and it's cheaper.
But the thing is, if the resident not paying rent or what, then you don't get that money as well, right? Whereas if it's a third party, then they handles with that. That's the only downside, I guess.
That's true. We just turn off their internet though.
Oh, okay, good. Okay, good. Yeah, that makes sense. Well, I'm just thinking,
like I said, it's a flip of a switch. It goes both ways.
Yeah. Well, I installed one of my property as a beta, right? But I had an option where I can install the whole thing myself through that company, or get that company to do everything, and we get 10-20% of whatever revenue everybody's making. So I chose the later part because I don't want to deal with people calling me to turn off internet and all that. But it could be something simple with technology. And as I said, you have to do something different to differentiate yourself, and that's what you guys are doing, right? You're buying smaller and you're putting a lot of technology. You're putting hard work. This is not like buy and forget about it, third-party property management, right? You have to implement all this software, which is a differentiation factor from a lot of people, and that makes a lot of sense in terms of investment, right? So,
thank you.
Awesome. Well, I mean, I appreciate that. So I always tell people you have to work hard, you have to be persistent. And the last thing is do things differently from everybody else. That's what exactly you guys are doing, right? So
that's right.
Awesome. Do you want to share about yourself and your company to our audience?
Sure. So myself, I talked a little bit about it earlier, but I spent about 12 years as a management consultant, flying all over the country, helping companies solve big problems. Essentially, it's what they paid us to do, is solve problems. So it really translates quite well into real estate, because that's how you make money in real estate, is you solve problems, right? And you find new solutions, and the tech piece goes directly along with that. Because a lot of what we did was around technology. So it all kind of works out really well. I'm able to leverage a lot of my skill set, and it's been fun just being a full-time real estate investor. From my company standpoint, so I'm a partner with a company called Birge Held. We are a Indianapolis-based multifamily private equity firm. We do single asset syndications. We have about $1.5 billion in assets under management, and about 15,000 units in the portfolio. And the way that, and so I'm a small piece within that. I have my own group, which we call Private Select, just kind of, playing off the idea of these smaller, right, selective properties. And I'm really focusing on kind of democratizing this sophisticated model for more retail investors. So folks just like me, how I said I started as a passive investor, I was putting $50,000 to $100,000 into the deals that I was doing. And so I'm giving access to the type of deals that we're doing and Birge Held's platform to those same type of people. Because those are the type of people I like to deal with and work with. And so that's really what we're doing. Birge Held has many strategies that are being implemented. My strategy is what we just described, which are these, like I said, mismanaged, undercapitalized, undervalued properties where we can come in and we can have a massive impact.
Got it. Awesome, Ken. Thanks for coming on the show. And I'm sure our audience and listeners did get a lot of value from our discussion. Thank you.
And if folks want to, if they want to get in touch,
I thought that's what you were supposed to say. Okay, go ahead now.
Oh, sorry. No, I thought you just wanted me to tell a little bit about what we were doing.
Give your contact information.
Yeah, sure. If folks want to get in touch, so you can go to kentritter.com. Very, very simple. That's my home base. We've got, tools for investors and things on there, and a little bit about more about what we do. And you can also listen to my podcast. It's called Ritter on Real Estate. And we focus on a lot of conversations like this, but just, how to be better real estate investors.
Awesome. All right. Thank you very much.
Thanks a lot, James.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.